The biggest problem I see with property investors or people who are trying to build a property portfolio is sometimes they have that dud investment or they buy the wrong property which does not have much capital growth, and therefore they're not able to get a valuation high enough to then release equity. Now, how could a buyer's agent help mitigate that?
Yeah, absolutely. We see that time and again. Clients reach out to us saying, "I've got a one investment property already, or maybe two investment property. I want to buy more investment properties, but I'm not able to do that. The reason being they bought in their backyard or they bought in an area which they are familiar with, not following the data, not following the numbers that we look at, not doing their proper due diligence in terms of the location that they're buying into, and that's the critical part. When you're looking to build a sustainable property portfolio, having a right strategy, having a right goal in mind. If you want to acquire 4, 5, 6 properties, you need to make sure you always have access to borrowing capacity. You need to target areas which gives you short-term growth, so that you can access that equity and then use that as a deposit to fund the subsequent purchases. So a lot of investors, they only think about just one property purchase and they make it and they're like, okay, we'll cross that bridge when we get there. But when we're talking to, when they talk to us, when we are forming a strategy, we're always thinking about, okay, yeah, we can do the next purchase, but what's after that? And that's where I guess, a mortgage broker adds a lot of value as well, because if you set that roadmap for a client, you can essentially help them, achieve their long-term goals as opposed to just one property purchase. Because at the end of the day, we want to build a solid, sustainable portfolio for clients and not just, one or two purchases. Because you can't really retire or have enough passive income to comfortably retire using one or two properties. Chances are you'll need multiple properties in your portfolio, and the shorter period of time that you take to accumulate that properties and let the compound growth kind of do its work, you need to access and buy in the right locations, which gives you that short-term growth and build that equity in the short term as well.
One of our mutual clients got a LMI refund of over $4,000 purely because of the location that you bought in, the short-term capital growth that had occurred.
Yeah, absolutely. Amazing story, right? It's pretty cool how we achieved that. It was buying in the right location, of course, but it's also buying the right type of asset. Now, with that particular location, it's very hot. The data is kind of pointing towards how the market is kind of getting hotter and hotter, but also the type of asset that we picked, it was under market value, required a little bit of a renovation. It wasn't desired by a lot of other property investors and home buyers. We saw value in that property. We spent a little bit of money, upgrading some curtains, cosmetic renovation, gave it a good clean, rented that property out, and then essentially revalued. And great work. You helped the client revalue their property through Commonwealth Bank, and Commonwealth Bank, quite generous with their valuation, gave them 65,000, I think, equity in 3 months time. So the client, first time investor, they're over the moon because they essentially got their deposit back, and they also, the LMI that they paid with ANZ, they got half of that refunded as well. So happy days. In fact, they called me just yesterday and said they want to buy their next property. So they're already starting to save up for their next property. So this is what buying in the right location and buying the right type of asset does for you. It gives you confidence to keep on going again and again.
What are the price points that you're generally buying, and what are some of the states you're really liking to purchase in as an investment property?
Great question. So what we're seeing at the moment is, for any investments or investors in general, the sweet spot is anything between 400 to 700K, because these type of property purchases, they're a bit more affordable. So they not only appeal to investors, they also appeal to first home buyers, downsizers, anybody who's looking to get into property market. So it's like we're targeting mass markets. Plus it tends to have better cash flow as well. So our rental yields tends to be better when the purchase price point is anything between 400 to 700. If you're going over 800-900, over $1 million, somewhere your cash flow wouldn't be as great, and you'll be buying the property for negative gearing and the reasons that you shouldn't be buying for. At the end of the day, if you want to build a sustainable, and if you want to grow up your property portfolio, you need properties that are generating good cash flow and making capital growth at the same time as well. So our sweet spot is anything between 400 to 700K. So if a client comes comes to us after talking to you, let's say they've got $1 million borrowing capacity, we would be ideally advising them to diversify and buy two 500K asset, or maybe one 400 and one 600K asset. Yeah. In terms of states, what we're seeing is in terms of trip to affordability, Queensland and Western Australia are the top of the charts in terms of that's where the market is heading. There's about 5 different markets to buy in regional Queensland alone, where the property prices are still under $500,000. You can buy a freestanding home, a 4-bedroom, 2-bath, good block size, 600 square meter block. We're talking brick and tile, low maintenance sort of properties. Yeah. So it's a no-brainer from an investment perspective. You want to buy something which is like that, which has got land to asset ratio is good. It's got good prospect in terms of capital growth, as well as good cash flow coming in as well. So that's what we're seeing in terms of that's where the market is at the moment. But we're also seeing new markets kind of emerging as well. So we're seeing a lot of regional Victoria is starting to emerge now as well. Melbourne is looking a lot more under market value. Yeah. Being a capital city, you've got Brisbane, Sydney, which is like really a lot of people are priced out now. So Melbourne is starting to look a lot better now as well.
People generally think in Queensland, because of the flooding, cyclones, etc., insurances can blow out their costs and really reduce that yield. How do you mitigate that risks for your clients when you're buying in Queensland and the regional Queensland area?
We get that question asked a lot. Everybody has got a preconceived notion in their head, which is like, oh, you shouldn't buy in these locations because they're cyclone prone, they get floods. However, we do our due diligence. Every time we are shortlisting a property, or even so, when we go through the due diligence, one of the first criteria that we look at is how to mitigate risk of, we don't buy properties in floods, we don't buy properties in bushfire, no heritage overlays. So we try to mitigate our risk like that. And in terms of numbers, we always do our cash flow analysis before making an offer on any particular property. So let's say we're working with the next amount of budget and we've accounted for a 500,000 property, the rent it should generate should be at least 550 for us to be able to sustainably hold that property even at the current high interest rate environment. So what we do is we always do our numbers. So we work out how much income that asset is going to generate and what the expenses are going to be. And expenses can include insurances, council rates, property management fees. And then we work out, what's the net amount that's going to cost you every year to hold that property? And we work that out, based on the tax they're on as well. Also any depreciation benefits that the property might also bring as well. So we always need to know our numbers before making offer on any property.
Often there's this misconception that you need to be a high income earner to invest in property. Now, can you give me an example of roughly how much the investment properties that you're generally buying, let's say with the average 5 to 6% yield, what is the rough range of money that they have to put in every month or perhaps every week to hold these properties?
Yeah. That's a great question. So in terms of, there's two things. When you're looking to buy an investment property, there's upfront cost in terms of capital costs required. So that's the deposit that you put down, stamp duty, and other costs that's involved at the point of acquisition. So what we're seeing is if you want to be a little bit more aggressive in your building your property portfolio, if you want to acquire multiple properties, then what we're suggesting clients, and a lot of clients, what they're doing is they're putting down a lower deposit and they're keeping the loan amount bigger. So your standard is 80% LVR, but some clients are also doing 90% LVR. They're happy to pay that little bit of an LMI. Just means that they can preserve that deposit and then they can buy a second property if they need to as well in a short period of time. In terms of ongoing costs, the type of properties that we are buying, we're targeting at least 5.5 to 6% yields. So in terms of holding costs, it's anywhere about $400 to $500 every month. It's good enough for us. So anything around maybe $3,000 to $6,000 every year is what it takes to hold these properties. And we do two scenarios. So we do one scenario which is at current interest rate, so at 6.5, 6.6% interest rate. We do another scenario which is like what would happen at 5.5% interest rate, and when your rents would have gone up next year as well. Majority of the property that we are buying will be positive cash flow when that occurs. So so it's better to get into the market sooner, buy something, And then essentially, we know that interest rates are quite high at the moment. So yes, you will be negative, but you'll be negative by a very small amount, something that you're happy with, doesn't impact your lifestyle and your household budget. And then essentially you hold on to those properties will convert into positive cash flow next year, hopefully when the interest rate comes down, and then those rents would go up as well, and the property would have grown in value as well. So the type of property that we are buying for our clients, it's costing somewhere around $100 a week. So let's say $400 to $500 per month, which is easy for somebody to own those type of properties. Again, we don't want to buy properties that is giving you stress. You want to be you should be able to sleep better at night, knowing that the investment is not going to cost you a lot. And even if the interest rate goes up by another 0.25 or 0.5 percentage, like it's not going to increase your holding cost drastically. So we do when we do our cash flow, we also work out at current interest rate, and we simulate in terms of when the interest rate goes down, and what if the interest rate was to go up, what would the holding cost be. So we do a lower amount and a higher amount in terms of rent and also interest rate when we work out our ongoing cost of holding a property. So Aagam, recently we had a client, he came and approached us saying, I'm looking to buy an investment property. He recently went to the bank directly, and the bank told them, yep, you've got some equity built up in your home. Looks like you're going to get 800K back. So the client approached us saying, I've got 800K equity and I want to buy property cash. To which, it's not very common. Often people come to us and, tell us, or they would have worked out their borrowing capacity. They would have approached a broker. But in this case, they approached us saying they've got access to that equity. They've already signed the forms and are expecting that money to hit their bank account. To the clients, it was shocking when we made an offer on a property, and turns out the client only got $200,000 in equity. Rest was actually loan that they refinanced on their PPOR. Wow. So, and then the client was stuck in terms of their borrowing capacity. They couldn't even finance the loan, the property that we purchased for them. So they got into some big trouble, and because we didn't put any subject to finance as well, because they were so confident they were going to get that money in their bank account. I asked them to approach a mortgage broker, and a mortgage broker in the end was able to help them out and go to a second tier lender and essentially get them a loan so they could actually finance the purchase. So it was a bit scary because it could have meant that they would have lost their deposit and not being able to buy an investment property when they thought they would be able to comfortably buy maybe 2 properties with the equity release. So I just wanted to ask you, as in, do you get clients like that who would approach a bank directly when they don't get the right information, and how do you help them educate, and how do you give them options in terms of different lenders when they're stuck in a situation where they can't finance the purchase?
Yeah, definitely. Often bankers can have some miscommunication because they're dealing with so many people who are potentially walking in the branch, and that could also happen with a broker. But as a broker, it's our job to really explain how much equity, when they are looking to take out equity, is coming into their pocket. That number needs to be really clear so that they can take that to their buyer's agent and therefore go and buy a property. Now, when we would have done that calculation, we would have made a nice table to understand, okay, this is the valuation, this is your existing loan, this is the 80% loan that you can go up to on the new valuation, and then therefore the balance is the amount of equity that you can release and use for either a deposit or buying in cash. Now, when it comes to choosing lenders, it's really important that we need to look at the whole situation of the client. We need to understand how much income is coming in and all their liabilities. Often with clients who already have 1 or 2 properties, they will find themselves maxed out with the major lenders. The bankers will probably stop answering their calls and probably tell them that they have no borrowing capacity left. Now that's when they come to us, and we can give options of 2nd, 3rd tier lenders who have much relaxed borrowing capacity measures, which therefore allows you to borrow perhaps another 1 or 2, borrow for another 1 or 2 investment properties. Now that can make or break a deal. So it's really important that we can present those options to them when they are maxed out with the major lenders.
So essentially you guys are problem solvers, right? And clients are only coming to you when they're in a situation where they need to get out of it, right? So I completely understand, at the end of the day, everybody has got a right. They can go to the bank directly and get a loan. If it's your first or second property that you're buying, yeah, you'll be fine. You can go to any bank, any major lender, and they'll give you the loan. I guess where it gets difficult is when you're trying to fund that third or the fourth purchases. A lot of people are, if they haven't bought the right structures, or they stick to the same bank that they're banking with, and go to them for loan, they get stuck essentially. There's a limit to the number of properties that you can own when you go with that sort of a mindset. How are you helping in terms of, let's say a client comes to you, let's say they don't have any debt, they don't have any properties, they're getting started in their investment journey. Let's say they want to buy their first property, and they come to you saying, I've got a goal to buy maybe 5 properties. How do you set them up? What are you suggesting? What's the kind of how do you kind of set them up for that success so they can continue to buy their third, fourth, fifth purchase as well?
They're not going to like this answer, but rate is not the number one priority in this. Number one is the sequence of lenders that you want to be using rather than the rate. The reason being is you want to start with the major banks where possible, because while you do get good rates, the major banks also provide quicker valuations and also more generous valuations. Now, your scalability of your portfolio is all dependent on the valuations that the bank provides on your property. So if they're more generous with the valuations and you start with those lenders, it'll be easier and quicker for you to get the equity out in the near, short or future term, and then go for your next. If you're focusing on the rate, what will happen is you may go to a lender who gives you the best rate. Perhaps they're a major bank, or they're also a second tier lender, can also provide really good rates. But the thing is, their valuations are very strict. They're always conservative, and therefore eventually you have to refinance back to one of the bigger lenders who perhaps providing you with a better valuation. Now, refinancing is not cheap anymore. You're not getting the cashbacks that you used to. So it's important that you start with these lenders and then make your way down to the second tier lenders. The second thing we do is we really want to understand exactly what you said is, how many properties do you want to buy? Now, if you tell me you just want to buy 1 or 2, perhaps you just follow the simple route of buying your personal name, it's simple there. But perhaps if you want to buy more, then we need to understand, okay, for the future purchases, we need to preserve that borrowing capacity. Now, that can be done by perhaps purchasing in entities, because once those properties are starting to wash their own face, there are lenders who we can go to, ignore that debt in that entity, set up a new entity and purchase in that. In doing so, you could potentially ignore the first entity's debts because they're taking care of itself. Now, obviously there's several risks and advice that you need to get for this sort of strategy, but that needs to be discussed beforehand rather than when the damage is done.
No, absolutely. And in terms of, you touched upon buying in right entities and trust structures, right? A lot of people approach us, potential clients and, even existing clients, they approach us, when is the right time to buy properties under the trust structure? Is there a guideline in terms of your first investment, second investment, third investment, when is the right time to form a trust structure and continue to buy under that entity?
Yep. Now, an accountant is best placed to give you the tax side of the answer, but I will give you the lending side of the answer. For lending, a trust is best used when you have your last bit of borrowing capacity remaining, because you have to preserve that borrowing capacity. So let's say your banker, your broker tells you now you have perhaps 500 or 600K left as your borrowing capacity. After that, you'll be maxed out with that major lender. That is perhaps a good time to say, okay, we need to preserve that borrowing capacity. The other thing that an accountant will tell you is it depends on the property. So we need to look at the property. Is it going to be something that is high cash flow that you're looking to, that you normally buy, or is it something that you want to do a development on? Then perhaps it does make a good idea to put that in an entity, because eventually when it is positively geared, you will be able to start distributing the income in the more tax effective way. Whereas if you're looking to buy a super negatively geared asset and it's going to have a lot of loss, but perhaps you're doing it with the intention of the property having really good capital growth, then it probably doesn't make sense to buy that in a trust unless there are other reasons such as asset protection or other reasons that the accountant advises you, because those losses are now locked in that trust and rolling over until there is a profit to offset those losses in the future. So There are several factors that need to be taken into account, but from a borrowing perspective, it's best done when you have that last bit of borrowing capacity left.
Yep.
Or if you're a business owner,
Yep.
who can then write off those losses by distributing income from different entities, you can take this strategy from the start.
Yeah.
Do you think if someone's looking to buy their first home and they're living in Melbourne and they're thinking, let me buy my first home, let me take advantage of these first home buyers schemes,
Yeah.
would you suggest they go buy a home to live in, or would you suggest they take the route of Rentvesting?
Yep. That's a great question. Like a lot of people approach us, especially from Sydney and Melbourne, because they're in a position, they've got enough deposit saved up, so they've got essentially two paths. One is, can they buy, should they buy their first home, or should they rent where they want to rent and then buy in a location which is a growth location where they'll make money in the short term and long term. I guess there's a couple of factors to consider. One is lifestyle. Like, are you somebody with a young family, with kids? Do you want to be in a specific location, like in a particular school zone? There could be other reasons why you want to be in a particular location, and whether you can actually afford to be in that location as well. A lot of people, what they do is, for their first property, they max out their borrowing capacity. They essentially, spend all of their deposit, put down a very big deposit, and then max out their borrowing capacity. And then they're not able to buy anything for the next 4 or 5 years unless their income increases or that property grows in value, or both of those things occurs, right? So the alternative strategy that we are recommending, especially, I'm finding a lot of people who are single, people who don't have other commitments, don't have a family. If they want that flexibility, they want to live in CBD, they want to live in an apartment, close to everything. It's not a great idea to go and invest in an apartment. So what they're doing and what we are suggesting them is, you can rent where you want to rent. You can rent an apartment, live the lifestyle that you want to, and continue with that, but buy in a growth location. So we would suggest them to, buy a freestanding home which will grow in value, in the right location, where the established home, where there's demand factors, where the data is pointing at as well. So rather than just, so you've got options open. So don't get, attracted by the first home buyer schemes and, buy a off-the-plan apartment or a home and land package. It's better to buy established home, because you'll start getting rent from day one as well. And most likely, that rent offsets the rent that you're paying, and that property is growing in value as well. So there's multiple benefits. Plus you can continue to build your portfolio as well. So Rentvesting is very beneficial, provided if you choose to live in a location where you want to rent as well. And also, let's say you can't afford to buy in a particular location and you still want to be there. Yeah. So then Rentvesting is for them as well, because then they can continue to kind of rent. And most likely, let's say if I give you my example, I've got a property that's got a mortgage of, let's say, $6,000. If I was renting the same property, I would be paying maybe $3,000 every month. So that additional $3,000 will help me buy maybe 2, 3, 4 properties as well in terms of holding costs, right? So that's the difference that it can make. Buying your first home may be a good idea for some people, but look, if you can Rentvest, and if your mindset is that you want to build a property portfolio, then Rentvesting is great for you, because then you can use that additional cash flow to essentially buy more properties and preserve that borrowing capacity essentially to continue to buy properties rather than maxing out on your first home itself.
The biggest myth people have is rent money is dead money. That statement has been passed down perhaps from generations.
Yep.
Where perhaps back in the day it was much easier to buy a property, and perhaps it would be a better decision to just buy that property rather than rent. But nowadays, with the prices in Melbourne, Sydney and these big metro locations, it perhaps makes it's cheaper to rent as long as you're using the remaining surplus cash to invest that money. Now that could be used in stocks or that could be used in property as well.
Yes.
Absolutely, yeah.
Another major benefit of doing so is that all your debt is deductible if it's used for investment purposes. If you're buying an owner-occupied property, you're paying the mortgage with your post-tax money. When you're buying an investment property, you're paying the interest, so not the principal, but the interest from your pre-tax money. as long as you've bought it in your individual name.
Yep.
Now that can be a massive advantage,
Yes.
and that could be really tax effective as well,
Yep.
and also help you build your asset base
Yep.
when you're starting off.
Yep. Absolutely. So like banks are a lot stricter. Like the lending criteria of the banks are a lot stricter now. Everybody has got a very limited resource when it comes to borrowing capacity. So it's very important to preserve that and to use it wisely. And that's why renting can be beneficial if you're somebody who's looking to scale your property portfolio, to build multiple properties and eventually give you options to generate passive incomes. So if you're thinking from that long-term horizon, then no, rent money is not dead money. I think it's sometime, as you said, it's cheaper to rent, especially in the current high interest rate environment. So if it's cheaper to rent, continue to rent, and then, but make sure you're using the additional borrowing capacity to buy something else as well, and you're not kind of, just letting it to waste. If you're putting your money or leaving your money in savings account, it's probably going backwards because of the inflation. It's eating the savings up. So it's important that if you're renting, then make sure that you're using the rest of the borrowing capacity to purchase an investment property. As you touched upon, it's good debt, it's tax deductible, and you can essentially buy the right type of properties in right location which are growing in value, and that is generating that cash flow for you as well, which is not costing you money to hold those properties. I think those are the type of assets that you want to have in your portfolio.
Exactly. I believe the best time to buy property is when you're living with your parents.
Yes.
Because when it comes to lending and you living rent-free perhaps with your parents or your relatives, is that all they do is they take a notional rent between $450 to $650 a month. That's it. Now we all know you cannot rent anywhere for $450 to $650 if you actually go out there. But the banks just take that little amount as a buffer if you were to move out of your parents' or your friends' or your relatives' house and perhaps go rent somewhere. But that's the key time where your borrowing capacity is going to be at its max with your current income, because they're only taking a $650 rent per month or $450 rent per month. That is the perfect time to maximize your purchasing window because you're able to borrow the most at that time. Now, obviously, as your income increases, you will be able to borrow more and perhaps...
So, I mean, you that's a great point. So at the end of the day, it's also timing, it's timing the market, but also time in the market. So say somebody is straight out of high school and is able to put down, a deposit, or with the help of the parents, using them as a guarantor, is able to purchase something. Imagine the time in the market they will have in the long run. And as we know, property compounds over time. So the longer that you are in the market, the more money that you'll make as well. And, with the equity that you're generating from that asset, you're able to go again and use that as a deposit. So you can essentially rinse and repeat, and you can continue to build your property portfolio. But yeah, that's a great point. If somebody can, not pay or at least not show to the bank that they've got any expense in terms of rent. Now again, rent and mortgage are the biggest expense, when it comes to showing, your expenses to the bank. So if you can kind of kill some of those, then that would improve your borrowing capacity drastically. So, and then if you can, match that up with some savings or deposit, or if you've got some, some access to some equity or whatever, then I think, it's a perfect time for you to, buy something and then essentially ride that wave of capital growth and then continue to build your property portfolio.
If I had 500K worth of borrowing capacity and perhaps 70, 80K deposit, where would you buy right now?
There's multiple markets to buy at the moment. The strongest market to me is regional Queensland, and there's like 4 to 5 regions to choose from where the property is at that sort of a price range. And I'm talking, you can get a good 500, 600 square meter block, good brick and tile, low maintenance type of property, which doesn't cost you to hold that money, and good cash flow as well. So it will give you a rent somewhere around maybe 550 if you buy the really good asset, maybe 600 per week as well. So it doesn't cost you much to hold those type of properties. So if I'm somebody just getting started, to build my property portfolio, I'd be targeting regional Queensland, and we do a lot of buying in regional Queensland for our clients.
People don't know this secret that you only need to earn around 60 to 70K as long as you have no other massive liabilities, and perhaps you're single or you're living with parents, or you're maybe renting somewhere relatively cheap or relatively affordable. you can still buy a 5 to 600k property and with a 10 to 12% deposit, which may only mean around 60 to 70 grand saved up.
No, absolutely. And that's why we always, every time a client comes to us saying they want to buy an investment property, the first thing we tell them is talk to a good savvy broker, who can work out the numbers, and talk to somebody who also owns investment properties and understands that investor mindset. If you want to build a property portfolio, you need to have a good team by your side. That includes professionals like a good accountant, a good mortgage broker, a good buyer's agent, and then we pair you up with a good solicitor and a good property manager as well. If you've got a good team around you, that can really set you up for success. And it's not just about one property purchase. If you want to keep on doing that again and again, you do need a good team around you, and definitely start with a good broker, because if they can work out how much deposit can you put down, and if you can minimize the deposit amount, then that will leave you the buffer to be able to buy the second one sooner, and and subsequent purchases will be a lot easier, because it's a combination of preserving your borrowing capacity and having a deposit to be able to fund a purchase. So we need to keep the right balance and make sure that every time we've got access to some deposit in form of equity or savings, and we're preserving borrowing capacity so we can go to the bank, get a loan, and then buy the investment property as well.